Something has just happened in the silver market that, if you have followed commodities for years like I have, you immediately recognize as abnormal. I'm looking at the screens, and what we're seeing is not just a price move, not just volatility, but a structural signal that breaks a pattern that held for decades. Silver is no longer behaving like the smaller, more erratic cousin of gold. It is beginning to move with the kind of tightness and urgency that historically only appears when supply systems start to strain. Let me walk you through what I'm seeing, because the first signs did not appear in the headlines. They appeared in the small, technical places that most people never watch. Inventories falling faster than expected. Physical premiums quietly rising in Asia. Delivery delays becoming more common in certain markets. And at the same time, the gold to silver ratio, a relationship that has acted like gravity for generations, suddenly compressing much faster than models would normally allow. These are what I call broken signals. When multiple indicators that usually move slowly begin accelerating together, it is rarely noise. If you've studied past commodity stress events, you know this pattern. We saw early versions of it in oil in the 1970s. We saw similar inventory stress signals in copper before major supply squeezes. And in precious metals, we saw echoes of it in the late 2000s, when financial stress collided with real physical demand. But what makes this moment different is that silver now sits at the intersection of two massive forces: monetary demand and industrial demand. That dual pressure changes everything. Now, many people assume price alone tells the story, but price is often the last thing to move. The real causes sit deeper. Global debt levels are at historic highs, forcing central banks to operate in a narrow corridor where tightening too aggressively risks destabilizing economies. Real yields remain fragile, and liquidity, despite cycles of tightening, continues to circulate through the system. When currencies lose purchasing power gradually rather than suddenly, hard assets begin to attract attention, not because of speculation, but because of structural hedging behavior across institutions and nations. At the same time, industrial demand for silver is not theoretical anymore. Solar expansion, electrification, and advanced electronics are not projections. They are happening in real time, and they consume metal in measurable volumes. Unlike gold, much of this silver is not stored. It is used, dispersed, and difficult to recover. That changes the long-term supply equation in a way many traditional commodity models still underestimate. And here is where the global confirmation comes in. We are not seeing this phenomenon in just one exchange or one region. Physical premiums in China have diverged from Western pricing. Export restrictions and strategic resource policies are quietly reshaping trade flows. Central banks continue accumulating gold, which indirectly reinforces the broader precious metals complex. Institutional flows into metals remain persistent, even while equity markets stay resilient. When signals align across continents, across asset classes, and across both physical and financial markets, it becomes very difficult to dismiss them as temporary anomalies. But there is a contradiction you should understand, and it is important. Financial markets still project calm. Equities remain strong. Volatility is elevated but contained. And bond markets are not signaling an immediate crisis. On the surface, the system looks stable. Yet, beneath that surface, leverage in paper markets, particularly in metals derivatives, remains extremely high relative to available physical supply. Historically, that kind of imbalance can persist for years, but when it adjusts, it tends to adjust quickly. So here's the reality as I see it, speaking to you directly after watching these markets for years. The silver market is not just rising, it is sending structural messages. Inventory behavior, ratio compression, physical tightness, and global demand patterns are aligning in a way that does not happen often. This does not guarantee a specific outcome, and markets can remain irrational longer than anyone expects. But it does mean we are witnessing a shift in behavior that deserves attention. And whenever a decades-old rule stops holding, history teaches us to watch very carefully what comes next. If you want to understand why gold and silver are behaving this way, you cannot look at charts alone. You have to step back and look at the entire macroeconomic landscape, because what we are witnessing is not a single market story. It is a global monetary environment shifting beneath our feet. I'm speaking to you directly here, not as someone repeating headlines, but as someone who has watched multiple cycles unfold, and I can tell you that the forces moving these metals now are the same forces that, in the past, preceded major turning points in financial history. Start with debt, because debt is the gravity of the modern financial system. Global sovereign debt levels are now far above what we considered sustainable, even 20 years ago. Governments are carrying obligations that can only be serviced under very specific conditions: moderate interest rates, stable currencies, and continuous liquidity. The moment interest costs rise too far, the system begins to strain. We saw early warnings of this during the European debt crisis, and again during the rapid rate hiking cycle earlier in this decade, when bond markets started showing stress. What that means in practical terms is that central banks are no longer completely free to tighten policy aggressively, even when inflation remains persistent. Now, look at inflation itself. Official numbers may show moderation compared with the peaks of recent years, but the underlying structure tells a different story. Services inflation, wage growth, and energy volatility continue to push prices in ways that are difficult to reverse quickly. Historically, whenever inflation settles above target for extended periods, think of the late 1960s leading into the 1970s, it changes behavior. Businesses adjust prices faster, workers demand higher wages, and savers begin to question the long-term purchasing power of currencies. Precious metals have always reacted strongly in these environments, not because of panic, but because of gradual shifts in trust. Another piece of the puzzle is the US dollar. You need to understand that the dollar is not just a currency. It is the foundation of global trade and reserves. When the dollar weakens, even slightly, it amplifies the movement of commodities priced in dollars. We've already seen periods this year where modest declines in the dollar index triggered disproportionately strong moves in metals. That relationship is not new. During the early 2000s, a sustained dollar downtrend coincided with one of the largest commodity bull markets in modern history. The mechanism is simple. A weaker dollar makes hard assets relatively more attractive and more affordable internationally, increasing demand across multiple regions simultaneously. Then there are real yields, one of the most misunderstood but powerful drivers in macroeconomics. Real yields measure the return on bonds after adjusting for inflation. When real yields fall or remain low, assets that do not produce income, like gold and silver, become comparatively more attractive as stores of value. We saw this dynamic clearly after the 2008 financial crisis, when aggressive monetary easing pushed real yields down and precious metals surged. Today, real yields remain fragile, and even small shifts in inflation expectations can push them lower again, reinforcing the same cycle. Liquidity is another factor you cannot ignore. Global money supply continues to expand, not explosively, but steadily. Balance sheets remain large, and financial conditions, despite periodic tightening, are still accommodative compared with historical norms. Liquidity does not disappear overnight. It moves, it rotates, and it seeks assets that preserve value when uncertainty rises. Metals often become one of those destinations, not because of speculation alone, but because institutions, funds, and even governments adjust their reserves gradually over time. And we cannot overlook geopolitics, because geopolitics changes financial flows in ways that models struggle to predict. Trade fragmentation, regional conflicts, and the growing trend of settling international transactions outside the traditional dollar system are all reshaping how nations think about reserves. Central banks accumulating gold in large volumes is not a coincidence. It is a strategic response to a more uncertain monetary order. Silver, though less discussed in official reserve terms, benefits indirectly from the same environment of uncertainty and resource competition. But here is the contradiction you must keep in mind as you listen to me. Equity markets remain strong, corporate earnings in many sectors are resilient, and economic data does not yet signal a global recession. On the surface, the system appears balanced, yet underneath that surface, structural pressures, debt burdens, currency dynamics, real yield sensitivity, and geopolitical fragmentation continue to build. History shows us that markets can operate in this state of tension for longer than most people expect, sometimes for years, before the imbalance becomes visible to everyone at once. So what you are witnessing now is not just a rally in metals, it is a reflection of deeper currents moving through the global financial system. Debt is high, inflation is persistent, liquidity remains abundant, currencies are shifting, and geopolitical risk is no longer a background noise, but a constant presence. These forces do not resolve quickly. They evolve slowly, then suddenly. And when you've watched enough cycles, you learn to recognize the moments when the surface of the market looks calm, but the deeper tides have already begun to change. Now I want you to focus on something that many people underestimate when they talk about silver. They still think of it primarily as a monetary metal, a smaller version of gold, something that rises and falls mostly because of investor sentiment. But if you've watched this market long enough, as I have, you know that silver is not just a monetary asset anymore. It is also a critical industrial material, and that dual identity changes the entire dynamic of how it behaves in the real world. Look at what is happening right now. Demand for silver is no longer driven only by jewelry or investment bars sitting in vaults. It is being consumed in solar panels, in electric vehicles, in high-efficiency electronics, in grid infrastructure. These are not optional sectors. These are the foundations of the global energy transition and technological expansion. And unlike gold, which is rarely destroyed and almost always recycled, silver used in industrial processes is often dispersed in tiny amounts that are uneconomical to recover. That means the supply leaving the system is not easily coming back. We have seen versions of this before in other commodities. Think about copper in the early 2000s, when rapid industrialization in China transformed what had been a relatively stable market into a structurally tight one. Inventories fell, demand kept rising, and prices began reacting not just to economic cycles, but to long-term infrastructure trends. Silver today is showing some of those same characteristics. Supply growth is slow, new mines take years to develop, and environmental and regulatory constraints are making expansion even more difficult. The pipeline of new production is not keeping pace with projected demand, and that imbalance does not resolve quickly. At the same time, investment demand is amplifying every move. Silver has always been more volatile than gold, and there is a structural reason for that. The market is smaller, liquidity is thinner, and price movements are more sensitive to flows from funds, options markets, and speculative positioning. When money flows in, silver tends to move faster than gold. But when liquidity tightens or profit-taking begins, the pullbacks can also be sharp. That volatility is not random. It is a function of the market structure. What makes the current environment unusual is that these two forces, industrial consumption and investment flows, are now reinforcing each other instead of offsetting each other. In the past, silver often weakened during economic slowdowns because industrial demand fell. Today, even with uneven global growth, structural demand from energy and technology sectors remains strong, creating a floor that did not exist in previous cycles. This is one of the reasons why inventory data and physical premiums have become so important to watch. And I want you to understand something about physical supply, because this is where many people misunderstand the market. There is a difference between paper silver and physical silver. Futures contracts, derivatives, and exchange-traded instruments create enormous volumes of trading activity, but the underlying physical metal available for delivery is far smaller. This structure has existed for decades, and most of the time it functions smoothly because only a small percentage of contracts ever require delivery. But when inventories tighten and delivery demand increases, even slightly, the system becomes more sensitive. We have seen early signs of that sensitivity in falling registered inventories and in the growing gaps between prices in different regions. Look at what is happening globally. In parts of Asia, physical silver is trading at premiums that do not always align with Western futures prices. Governments are paying closer attention to strategic resources, export restrictions, stockpiling behavior, and domestic demand priorities are reshaping trade flows in subtle but meaningful ways. These are not headlines that dominate financial television, but they are signals that experienced commodity analysts pay close attention to, because they often precede larger shifts. There is also a psychological dimension to this market that you should not ignore. When investors begin to see silver not just as a speculative asset, but as a material tied to long-term industrial growth, their behavior changes. The narrative shifts from short-term trading to structural demand, and that shift can sustain momentum longer than traditional models predict. We saw similar narrative transitions in rare earth elements, in lithium, and in other materials that moved from niche commodities to strategic assets. But here again, there is a contradiction you must hold in your mind. Silver is still volatile. It still experiences sharp corrections, sudden rallies, and periods of intense speculation. The market can overshoot in both directions, and history is full of examples of dramatic spikes followed by equally dramatic retracements. The dual nature of silver means it can behave like a monetary hedge one month and like an industrial commodity the next. That complexity is precisely what makes interpreting this market so challenging. So, as you listen to me, understand this clearly. Silver is no longer just riding the coattails of gold. It is being pulled by two powerful engines at the same time: monetary uncertainty on one side and industrial transformation on the other. That combination has rarely existed at this scale in modern history. And when you see a market influenced by forces that operate on completely different time horizons, you begin to realize why its behavior can look so unpredictable on the surface, yet so logical when you step back and look at the bigger picture. Now we come to the part that matters most, the part everyone asks about when the cameras are off and the charts stop moving for a moment. What signals actually matter from here? And what should we be watching if this structural shift continues to unfold? I want you to listen carefully, because markets rarely send clear warnings. They send fragments, small signals that only make sense when you connect them over time. The first thing I'm watching, and the first thing you should understand, is liquidity. Not headlines about rate cuts or hikes, but the deeper movement of money through the global system. Watch money supply trends, watch credit conditions, watch how central banks respond when financial stress appears. History shows us again and again that when liquidity expands quietly in the background, hard assets tend to respond months later, not immediately. This lag is something many people misunderstand. In the early 2000s, liquidity expansion preceded the commodity supercycle by years, not weeks. The same pattern appeared after 2008, when metals began their major advance, well after the first emergency measures were taken. The second signal is institutional behavior. Retail flows can move markets in the short term, but long-term trends are driven by large capital. Central bank purchases, sovereign reserve diversification, ETF flows, and large fund positioning are the footprints of structural change. When central banks accumulate gold steadily over multiple years, it is not speculation, it is policy. And when institutional money begins allocating to metals as part of broader risk management strategies, that shift tends to persist longer than most people expect. Another signal that matters is the relationship between interest rates and inflation expectations. You must understand the concept of real rates, because this is where the true pressure on financial assets emerges. If inflation expectations remain elevated, while nominal rates stabilize or fall, real rates decline, and historically that environment has been supportive of precious metals. We saw this in the 1970s, when real yields turned deeply negative and metals entered one of the most powerful bull phases in modern history. We saw echoes of it again in the years following the global financial crisis. These cycles do not repeat exactly, but the mechanics remain strikingly similar. At the same time, I want you to watch the gold-silver ratio and inventory data. These are not flashy indicators, but they are incredibly revealing. When the ratio compresses steadily, it often signals that silver is gaining relative strength, not just rising because gold is rising. And when inventories decline while demand remains steady or increases, it tells you that supply chains are tightening in ways that prices have not fully reflected yet. Commodity markets have always moved in this sequence. First, inventories tighten, then premiums rise, then price reacts, and only at the end do headlines appear. But here is where the uncertainty enters, and I want to be very clear about this. Markets never move in straight lines. There are always counterforces, a sudden rise in real yields, a sharp strengthening of the dollar, or an unexpected tightening cycle could slow or reverse these trends temporarily. We have seen it happen before. In 2013, during the so-called taper episode, precious metals fell sharply, even though the long-term structural issues in the global economy had not disappeared. Short-term forces can overpower long-term trends for extended periods, and that is one of the hardest lessons in macroeconomics. There is also a psychological factor that becomes critical in the later stages of any cycle. Narratives begin to dominate analysis. Extreme optimism appears, then extreme pessimism, often within months of each other. Volatility increases, not because fundamentals have changed overnight, but because expectations swing faster than reality. Silver, in particular, has always been prone to these emotional waves. And when volatility rises, it can create the illusion that the underlying trend has ended, when in fact it has only paused. So, what does all of this mean in the larger sense? It means we are living in a period where multiple long-term forces, debt, liquidity, currency dynamics, industrial transformation, and geopolitical fragmentation, are converging at the same time. These are not short cycles. These are generational forces. The last time we saw a convergence of this magnitude was during the 1970s, when the global monetary system itself was being redefined. That period was marked by volatility, uncertainty, and rapid shifts in asset behavior, and many people at the time did not realize what they were witnessing until years later. And I want to leave you with this thought, speaking directly to you as someone who has spent years watching these cycles unfold. The most important moments in financial history rarely feel dramatic in real time. They feel confusing, signals conflict. Markets move in ways that seem irrational. But when you step back and connect the pieces, the liquidity trends, the inventory data, the institutional behavior, the macro pressures, you begin to see the outline of a larger shift taking shape. We are not at the end of this story. We are in the middle of it. The signals are still forming, the pressures are still building, and the markets are still adjusting to forces that did not exist a decade ago. And whenever the rules of a market that has behaved one way for decades begin to change, experience teaches you one thing above all else. Watch carefully, stay alert, and never assume the old patterns will hold forever.